at August 1st, 2010. During the year ended 31st July 2011, the company sold non-current assets for $25,000 US, on which it made a loss of $5,000 US. The depreciation charge of the year was at $20,000 US. What was the carrying amount of the non-current assets as at 31st July 2011?
Yes. So what was the answer? What did we write? What's the correct answer? We can discuss. The last time class was a very good one because all of us were participating and we learned a lot of things together. So I would recommend that you do it like that even today. So people can participate so that we can reason together. Anyone? Hello. Can you hear me?
Yes, sir.
Hello.
Anyone? Yes, sir.
I think it's the answer is D.
Okay.
The reason I'm thinking it's D is since they're saying that the total of the current assets they had was worth $200,000. When they sold those current assets, they still had the cash at hand, which is also a current asset, which was supposed to be $25,000, but they made the loss of $5,000, which means the only amount we need to deduct from the 200,000 is the depreciation and the loss they made, which is 5,000. That's my take on this question.
Okay, interesting. Any other? Do we have any other view? Okay, all right. Mr. Ashtoka, before I comment, let me find out again what you said concerning the 5,000 loss. What did you say concerning the 5,000 loss?
No, so I think I'm going to change my answer again.
Okay, you can change it.
Yeah, so my answer for the total non-current asset is going to be 150.
Okay.
Which is A. Yeah, and I'll give the reason is because cash is not its current asset. So even if they sold something that is worth 25,000. So from the answer that I'm going to give, maybe let me just say what I'm seeing. They sold $25,000, which means what is remaining is 150,000 of assets. Then from there, we see that they made a loss of 5,000, depreciation at 20. So which means
Sorry, I get the feedback.
Yeah, I'm getting a feedback from where is this one? Mr. Sylvester. Mr. Sylvester. Mr. Sylvester, would you mute your mic, sir? Or you are saying the answer? Hello, Mr. Sylvester. Okay. The admin has authority to mute people. Their mic. Yeah, you can continue talking. I'll be muting those people who, yeah.
okay, so as I was saying, so the amount, as I was saying, was when they sold these assets, these non-current assets, they sold them at $25,000. Then the depreciation was calculated at $20,000. So these 20,000 plus the $25,000, then you subtract from 200, which will give us 155. That's my answer. So this loss they made was for the current assets because the cash at hand will be current asset. That's my take.
Okay. All right. Do we have any other, or I pick the coming? Yeah. Okay. Here's my submission now. My submission is that the solution is supposed to be 150 because when you look at this, when you say they sold, for us to record that this is a sale of the money, when do we record a sale? When does a sale become a sale? When we receive the money, right? We see the money. If you haven't yet received the money, that is not a sale. A sale becomes a sale once you receive the money. So these guys, they received what? They received a 25,000, but initially they were supposed to receive a what? They were supposed to receive a third pin. So there is a loss of 5,000. That should add, when you add that plus the amount that they received, so the amount that was removed from the assets. Remember, we are calculating what was removed from the asset, okay? What was removed from the asset, whatever it was, whether it was removed as a loss, or it was removed because we sold it, or it was removed because it depreciated, okay? So whatever was removed from the assets was this total. So you have a 30,000 plus 20,000 giving you 50,000. That should be subtracted from 2,000 to give you 150,000. Clear?
No.
Okay.
Yes, I think it's clear.
Somebody said no.
No clear
I
for
hear?
me.
Yes, madam.
I'm trying to understand where the 30,000 came from, first and foremost, because here I'm looking at $200. Then there is also 5,020.
Okay.
So if we add any figures that amounted to 30,000.
Oh, where did the figures that amounted to 30,000?
Yes, please.
Oh, okay. I said that the figures that made us to make a 30,000 was because there was the number one. We sold this the assets that are worth 25,000, right? So we no longer have those assets out of the total of 200. Then plus a loss of 5,000, that makes a 30,000, right? You can unmute your mic.
Yes, sir.
Yes, a 30,000, then plus the 20,000 that is charged on a straight line depreciation method. That should give you a 50 what? A 50,000, and then you get a 150.
Okay. Yes.
Hello?
Yes, I'm listening.
Yes. Did you get that now?
Yes.
Is there any question?
No, thank you.
Oh, okay. Thank you then. Any other question? Anyone can still ask you the questions. You can ask. Okay. Question number 20. Question number 20. Lusungu, would you read for us question number 20?
Okay. Which of the following calculates a sole trader's net profit for a period? A, closing net assets plus drawings, capital introduced, opening net assets. B, closing net assets, drawings, plus capital introduced, opening net assets. C, closing net assets minus drawings, plus capital introduced, minus opening net assets. D, closing net assets minus drawings, minus capital introduced, minus opening net assets.
All right. What is the solution? Anyone can participate.
It's G.
Why do you say so, Sam?
Looking at the information given above, we're looking
Yes,
at
sir.
the net assets. We need to remove the drawings. This is the monies which are done by the owner of the business. Then we also remove the capital and the opening net assets to come up with the net profit.
Okay.
I submit.
All right. Interesting. Any other? Yeah, these are just the equations from the financial statements. You know, you remember the statement of profit and loss and the balance sheet. Yes, you remember that how you come up with the profit and loss account. Picture it from there so that you can easily get it. So can you manage to see in your head the net profits from the profit and loss account? You see the net assets in the balance sheet, and you see the drawings and capital introduced in the balance sheet. So what could be the correct answer?
I think D, sir.
You think D too?
I concur with you.
What about others? Everyone is free to participate.
Opening net asset. There's no answer, sir.
Okay, interesting. There is no answer. It's an answer also. Any other? Okay. If you have just trying to think together, I want you to follow. I'll be asking you questions, then you'll be reasoning with me. So the question is, why should the drawings be added to closing net assets or should be subtracted? Why do you think the drawings should be added? Any other, any of you? Why do you think you need to add the drawings? Let me show you something. Yeah, so that we can be reasoning together. Okay. Okay, the difference between the net assets, when you minus like closing net assets minus the opening net assets, you just have that difference at the net assets, right? This is just an accounting equation, you know, that you know. The net assets, the net assets that you have should be equal to capital plus what? Plus liability, right? Which you also call, let me say, capital plus liability. You call it equity sometimes, plus liabilities. And from that equation of yours, there is that equation from the balance sheet, because you observe this from the balance sheet. You'll understand that after you have found the net assets, I don't want to tell you the answer like right now. I want us to show you, then you pick the answer. Follow nicely. You have the net assets. As you have the net assets, this should be equal to, then on your balance sheet, right? You are seeing your balance sheet. What begins on top first are the net assets. From the net assets, what you should have is the capital, of which that capital is made up of capital introduced. To capital introduced, what do? You add what? You add the net profit, isn't it? Hello, do you remember that equation? You add the net profit. Then from net profit, what do? You less what? You less the drawings. Do you remember?
Yes.
Yes, you are listing the drawings from that equation. So now the question is, when you look at this equation, then you have the net assets here, the difference in the assets, the net assets in short. Which one gives you which one gives you the yeah, okay, what's the solution in short? It's what?
It's
Okay.
A.
The answer is what? Is A.
A, yeah, A.
Have you managed to observe the way how you're following? Just from the balance sheet, you learned that you have the assets, that accounting equation, you know, assets should be equal to what? To capital plus what? Capital plus liabilities, right? Isn't it?
Yes. Yes, sir.
Yes. Capital plus liability. Let me drive it for you so that I don't want you to memorize things. I want you to understand. That's when I'll be okay. Check what is happening. Driving the equation. The accounting equation says that total assets should be equal to capital plus what? Liability. Isn't it? Then when you say assets minus liability, this should be equal to equity, which is same as capital, right? It should be equal to equity to capital, right? So now check. I'm driving the equation for you, that one. Assets minus liability is called net assets, okay? Net what? Net assets. Net assets should be equal to what? To capital. Now, what are some of the things that make capital? Under capital, you have number one, capital introduced, okay? Plus, to capital introduced, you add what? What do you add? You are adding net profit, isn't it?
Profit.
Net profit. Again, you are
Net
adding
profit.
what?
Yes.
You are lessing you are subtracting the drawings, right? Then from here, you just in short, this is what is on the right side of the equation. So you're just making net profit the subject of the formula, right? From basic mathematics, you learned that since you are making, you know, we are expressing the whole expression in terms of net what? Net profit. Capital here is positive. When it comes to the other side of the equation, it becomes what? Negative, right?
Yes.
Yes. Capital should be negative on the other side of the equation. So your equation will be, let me just write net assets minus what? Minus the capital, right? You're following. Capital is removed. Then what else? We are making net profit to remain to the other side of the equation. Capital introduced, it should be subtract. Drawings, they are negative this side. They should be what? Positive, right? Drawings. And this should be equal to net what? Net profit of a sole trader. Did you get that?
Yes.
Somebody will think this is different. It's not just different from A. They're just the same. Okay? It's just same as A. So drawings will carry a positive sign because they would have crossed the equal sign. Capital as well will carry a negative because it would have crossed the what? The equal sign. And that is the thing. Any question? Anyone with a question? Okay, there is no question. Question, oh, you're on question number what? Question number 21. Hilda Piri, would you read for us question number 21? Hilda Piri, read for us question number 21.
Just a minute. So this, okay, the screen is back. Question number 21. Which of the following statements are true about limited liability companies? 1, the company exposure to debt and liability is limited. 2, financial statements must be produced. 3, a company continues to exist regardless of the identity of its owners.
Interesting. So what is the solution? We know liability, limited liability companies, right? Who can explain to us what they are? What is a limited liability company? Hello? Hello? Am I logged out? Oh.
No, sir.
Okay.
Hello?
Yes, sir.
Hello?
Yes, we can hear you.
Okay, so limited liability companies, I can say it in these two ways. Firstly, these are companies which have got characteristics where they're like separate from the owners. They are like,
okay.
In fact, they are separate from the owners, and their debt does not affect personal assets.
Okay. All right. So just as explained, with limited liabilities, maybe just trying to give you an example. If the company goes under, or to go under simply means like the company stops existing. Before the company stops existing, or let me not give that example. Like if the company maybe commits a crime or something, then you try to gather the resources of the businesses are not enough. Okay. Then those people whom the company owes don't have the power to come and ask the company to actually give the amount, like give their personal assets. They won't say, since you have a house, you have a house, so we're going to sell your house so that you can pay for the company, and because you're a shareholder or you are the owner of the company. No, it doesn't work like that. So if you report that this company just has a million, and so the money which is there is no longer enough to meet I would say, to pay for this liability, then there is nothing else that we can do. Even if the owners of that company, they have their personal assets. So that's what was just explained. So those are like the liabilities, and they are separated from the owners. Those are limited liability companies. We have known what they are. Any question on what they are? We are still looking at what they are. Then with limited, before you can ask it, with limited, what is there is that it's the opposite. Yeah, the liabilities are not separated. Those liabilities of the business. So you find that the people can still come to the owners, even if it is the business which has the responsibility to pay for that liability. They will come to the owners and say, you can give us your personal assets for the sake of the business or on behalf of the business. Yeah, sorry. Any question? There is no question. Then what is the correct answer now?
The answer is B.
Okay, 1, 2, and 3. That's interesting. What about others?
I'll go with A.
You're going with the A?
Yes, sir.
Why do you say so?
Though financial statement must be produced somehow, but we're not sure. So I think not part of unlimited companies. But these two, I'm very sure of them.
Okay. What about others?
Hello.
Yes, sir.
So on the financial statements, if you form a public limited company, you actually have to produce the financial statements. It's a requirement by the law.
Okay.
Thank you.
A publicly limited company, right?
Yes, if it's a public limited company.
What about this one? Does it state that this is a private limited company or a public limited company?
This one is just open, that's why I chose all the 3 answers.
Okay, interesting. Any other? Any other? No one is submitting. Okay, my submission. It is 2 and 3. How about that one? I'm not saying it is an answer. Why don't you think the answer is 2 and 3, or it is not 1 and 2, or 1 and 3? The idea is just to attack these solutions, find the reason why they are not answers. Once you know the reason why they are not answers, then we'll okay. Okay. So
Yeah, I think
what
that's the correct answer, sir.
the answer is, which one is correct answer?
2 and 3, I didn't see the part where it says the exposure to debt.
Okay.
The
All
company's
right.
exposure to debt and liability is limited.
Okay. Thank you. Yeah. So what is happening is that check number one, don't just look at debt and liability is limited. The company exposure to debt and liability is limited. Is that true? It is not true, obviously. The exposure to debt and liability is not limited. So the answer is 2 and what? And 3 only. Clear? Or maybe there is someone who has a different view. Madam Smanza, what's your question? Hello? Okay. None of us has a question, then we can move on, right? Question number 22. The plant machinery account of a business for the year is given as this one, okay? So the company policy is to charge depreciation at 20% per year on a straight line basis, with a proportionate depreciation in the years of purchase and disposal. So what should be the depreciation charge for the year ended 1st December 2015? What's the solution for this one? Anybody? Madam Simanza, what's your question or what's your take on this one?
Okay, just a minute. Let me
Calculate.
I'm calculating.
Okay, thank you. Others, can you still be calculating? What about others? Oh, hello.
Hello?
Yes, sir.
So we're going to calculate, from what I understand, using the straight line basis, 20% to that amount, which is the balance, because that balance will be that balance on the 31st December, which is 340,000. Then you multiply 20%, which is 68,000. That's my
Okay.
calculation.
Interesting. What about others? And why? maybe the question should be, why did you pick the balance carried down? Or the balance carried down? Why choosing the balance carried down? Oh, okay. My submission. Yeah, you are calculating this on a straight line Nankin. Yeah, basis. So what is there is check what is happening. These things, they are being bought at what? Different months, right? You have the balance brought down January, June, March, right? So you will need to account for those months. You need to account for those months, okay? So number one, to begin with, what is the depreciation for the first 3 months for this asset? For the first 3 months, January to, yeah, that piece. Let's just get the first 3 months. So it should be 60,000 times what? 0.20 multiplied by, it's 3 months, eh? Should be 3/12, like that. What do we get? What do we get for the first depreciation?
$300.
300?
Yes, sir.
60,000.
It's 300.
Okay, 300. What about this one which came in June? That's 6 months. You purchased a plant that was 160,000 times 0.2 times 6/12. How much is it?
$16,000.
Sorry?
16,000.
Yeah, 1,600.
1,600, 16,000. Like 160,000 times 0.2 times 0.5, because this one is 0.5. Let me write 0.5. 0.5 times 0.2 times 160,000.
$16,000.
16,000, right?
Yes, 16,000.
Okay, 16,000. Even for the first one, you had done 0.2 times 0. Oh, what is that was 3 months. 3/12, it should be what times 60,000. 60,000. Oh, you had done 60,000. You had done just that. Right?
Yes, we did just that, sir.
Oh, okay. Then now
Hello?
you need the hello.
I think as for me, the first one is giving me 3,000, not 300.
Yes, that's what I expect. Like if you say, what is 3 divided by 12? You say 3 divided by 12 first. Then the answer that you find, you multiply by 0.2. Then you multiply by 60,000.
Yes, it's 3,000.
3,000.
It's 3,000, right?
Yes.
Okay. 3,000. All right, we are fine now. Then there was this asset had the period like it was there now the full period, like from the time you got it. That's the balance brought down. Let's say like sorry, let me explain clearly. This balance brought down, this value brought from this opening balance, the one you brought from the previous period. You should minus this, subtract this transfer disposal account. Like you have removed the assets now, like you have removed it in this part on this particular day. You sell it off, dispose it off. You subtract that, and what do you get when you remove that? $240,000 minus 60,000.
180,000.
180,000. Oh, okay. All right. Let's try to add them together. Oh, it's 180,000. No, that's not depreciation. Yeah, that's just the value. So you multiply now by depreciation. So let's say 180,000 times what? This is 12 months now. So you just multiply by 0.2. What does it give you?
36,000.
36,000. So when you add these together, what do you get?
$55,000.
Yeah. So you have 55,000. Let me explain the reason why.
Sorry, sir, when you add what and what?
When you add the depreciations that you have found, like these depreciations you have found, right? You had found 3,000 for that for the first 3 months. You had also found the, what's that? 36,000 for 12 months. So that is that period. The asset, there is the asset that is stayed from January up to December. You get right? There is that asset which is stayed for 12 months. And then there is that other one. Which one was that?
It was
the
16,000.
This one for 12 months. This one which came in June. That was
16,000.
Yes. So when you add these all together, they have given us what? 55,000. That's what they're saying.
Okay. Yeah.
So now, any question? Okay. Now here is the thing, right? It's common by you can easily you can sometimes guess and find the answer. For example, you can guess it and find some figure, but it is not really correct. For example, you've seen now, it was coincidental that when you multiply this amount by this is 340,000 thousand by 20%, it gives us what? 68,000. You've seen that, right? Now, check that. This is now for the full year, like from January up to December. It was going to be correct if and only if we, like there was no adding of things in between. You get, but these assets were brought in different months of the year. So you can't say that the asset that have stayed from January up to December is same as that one that has just stayed from June up to December. You get, it's different. The depreciation cannot be the same. Did you get that?
Correct.
Okay. All right. Question number 23. Question number 23. Mr. Sidin, would you read the question for us?
Oh, thank you, sir.
Bluetooth is ready to pair.
Hello, sir. Can you hear me?
We can hear you.
Yes, sir. Question 23 leads the IASBS conception of framework for financial reporting identifies fundamental qualitative characteristics that mark financial information faithfully represents what it purports to represent. Which two of the following are characteristics that are required to ensure faithful representation? A, completeness. B, accruals. C, naturality. D, going concern.
All right, thank you. So friends, which one is an answer? We can participate. All of us can participate. Which one is an answer? There are two. You need two answers in short. The answers are two. Which two of the following?
A and C.
A and
Completeness
C.
and yes.
A and
Okay.
B.
A and B. Interesting. Any explanation?
For any financial reporting, sir, we should ensure that there should be completeness of any financial reporting. And as we do those, we usually have accruals. That means, I don't know how to explain this, but yeah, yeah, but I think A and B should be the answer. I don't know. Yeah, that's my take.
Thank you very much for that take. Any other explanation from anyone? You can pick the answer and explain. Someone had chosen the A and C. What is your basis? Baby Lusu, what's your take? Veronica, what do you think concerning this one? What's your take on this one? Okay. All right.
Hello?
Yes, sir.
No. So the reason why I chose A and B is because there shouldn't be any missing information when you're preparing financial statements. That's for A. It must be complete. You shouldn't leave out anything. Then in neutrality, that's to do with the, you have to be like fair, no errors in it. Like when you're making, you must make sure that you go through so that there are no errors in the statements that you're making.
Okay. All right. The International Accounting Standard Board's conceptual framework for financial reporting identifies fundamental qualitative characteristics that make financial information faithfully represent what it purports to represent. So the following are there to ensure faithful representation, completeness, and the neutrality. Why not accrues? Why not going concern? These are accounting concepts, okay? Like accrues or concept. These are accounting concepts, but they are not same ones that are like there to guide. What's that? To guide the characteristics. What should I say? To guide the way how the information is presented as guided by the International Accounting Standard Board conceptual framework. So the guide is that there should be neutrality, there should be completeness, actually. Anyway, those are on the first chapter of your notes. I think if not first unit, then it should be this, yeah, third unit. Yeah, third unit. Yeah, but they are just simple small notes of those regulating boards. Yeah, usually questions rarely come from there. So that's why I never had time. I didn't comment much on them because it's rare that you have questions. Okay. Veronica, would you read for us question number 4?
Hello, sir.
Yes, sir.
Hello. Yes, I
Yes,
kind
sir.
of lost
You
network.
said question
So I
number
don't know
4.
the submission on your previous answer.
Sorry?
The previous question.
The previous question, my
What was your
submission.
submission on the previous question? Yes.
A and C.
Because I lost network.
Completeness and neutrality.
Okay, perfect.
Yes, because accrues and going concern, those are accounting concepts. Yeah.
Yeah.
Okay.
Hello, sir.
You can read, yeah.
You said number 4 or 24?
24.
Okay, sir. Question 24 read, when is the reducing balance method of depreciating non-current assets more appropriate than the straight line method? Number A, when the expected life of the asset is short. Number B, when the asset is expected to decrease in a value by a fixed percentage of the cost of a year, of the cost each year. And then number C, when the expected life of the asset is not capable of being estimated accurately. And then number D, when the asset is expected to decrease in value less in later years than in the early years of its life.
Yeah. So which one is the answer? Anybody?
Hey.
Give your. Why do you say so?
When is the reducing balance method depreciating negative?
Question. Conduct the question I'm asking.
Hello? You give your answer, you defend it. Yeah, don't worry. It sounds time wasting, but you will appreciate this one day in the long run. Hello.
I'm with you, sir.
Yes, what's your take on this one?
I know the answer is A, but I don't know how to defend it.
How do you know? And you can't defend what you know. That is interesting. What's the take? Hello. Okay. You like my submission so quickly. I really expect you to participate, say something, and then that's when I come in to submit. It's fine. Whatever you say, whether it is not same as what I submit, it's still okay. What we want you to do is to help you see why that is not an answer. You get, if you just skip it, really, you are not learning. So it's better you say it, then we help you. Okay, my submission quickly is D. When the asset is expected to decrease in value less in later years than in the what? In the early years of its life.
Sir,
Madam,
why not B?
why not B? Question to the class, why not B? Anyone? Okay, before we come to B, before we comment on B, still on D. Why do we say that D is the answer? You know, the reducing, listen, the method assumes that the future benefits associated with the asset decline more in the earlier years of the asset's life than in the later years. Okay, that is the assumption under reducing balance method. So the method is more suitable to use when it is assumed that the asset will be used more in the earlier years than in the what? In the later years. That's why I submit what? D. Did you get that? Hello.
Yes, sir.
Yes. So now let's look at B. Why is it not an answer? Someone is asking, why not B? Look at this. If this B is for straight line method. If you check when we are calculating straight line method, we assume that the asset is decreasing in value at a fixed what? Percentage of costs. You get that, right? It's a fixed. Let's say if we like just the, if we say it is decreasing by 20%, you'll be just multiplying the cost of that asset, okay? If that asset was maybe 200,000, then you just multiply that by the 20%. You get, right? There is nothing like,
Yes, sir.
yeah, this is a straight line method on B. Did you get that?
Okay. Yes, sir.
Happy?
Very happy.
Okay. Hilda Piri, would you read for us question number, which one is this? 25? Did I look at this question? Okay. Let's read it. Let's read it.
Question number 25 reads, Louis sold goods to Pedro in May 2019 with a list price of $98,000. Louis allowed a trade discount of 10%. Pedro returned goods with a list price of $3,000 on 31st May, and returned a further $5,000 of goods at list price on 6th June, as they were found to be unsuitable. How much should Louis record in the sales returns account at 31st May?
Okay. Yes, friends. Hello.
Yes, sir. Can you hear me?
Yes, sir.
Yeah, sorry. My network is quite bad. So I was asking, what was the submission on number 24?
The answer is D, sir.
D.
It is, yeah, D on number 24. I was saying that the reducing balance method assumes the future benefits associated with the asset decline more in the earlier years of the asset's life than in the later years. You get that, right? That is the assumption which is there under reducing balance method. Therefore, since we assume that the asset will be used more in the earlier years than in the later years, then D is the, yeah, my submission. Did you get it? Hello?
Yes, sir.
No, you got it? Oh. All right then.
Yes, sir.
Hello, did you hear me? I was talking.
Yes, sir.
Hello, did you get the
I
answer?
can. Yes, sir. Yes, I did. Thank you.
Oh, okay. We are on question number 25. What is the solution for this one? What is the solution for this one, friends? How much should Louis record in the sales return account at 1st May? Should she record 3,000 at 1st May? Should she record 8,000, 27, or 7,200? How much should she record?
I think 8,000.
8,000? Why do you say so? I like it when you explain why you're choosing the answer. Hello? Hello? Or any other submission? Just give us your submission. Right. Okay. So the answer is A. Okay. The answer is A. We move.
No, sir, just explain.
Yeah, that's what I wanted
Hello.
to hear. Yes, sir.
So from that answer, so does it mean even the returns must be they must have a reduced balance from the 10% that we give out?
Okay, now listen, I explained. That's why I didn't even move forward. I wanted to explain. So listen, they are saying that, listen, Louis sold goods to Pedro in May 2019 with a list price of that. Louis allowed a trade discount of what? Of 10%. You get that, right? There was a trade discount that was allowed. So Pedro returned the goods with a list price of that. Okay. So what the person is returning, what the person is returning is a good that has got a list what? A list price. Okay. Now what does it mean? Since 3,000 is a list price and is not inclusive of the discount. You get that, right? A list price is not inclusive of the discount. Okay, therefore, the discount will be reduced. Did you get that? From the amount? The discount should be reduced should be removed from the list price, because the list price is never inclusive of the discount. Did you get that? Yeah. So the discount that we have is 10%. 10% of 3,000. Okay. 3,000 times 0.1, which is 10%. It gives us 300. Okay. So we should remove 300 from this. Yeah. From 3,000 to give us 2,000 and what? And 700. Did you get that? Hello. Hello.
Yes, sir, we've gotten it. We've gotten it.
Okay. Yeah. So that's the thing. Yeah. When we talk about a list price, you don't include it's never inclusive of the of the discount. It's not inclusive. So if the person is getting at the list price, it means there is no discount that should be added. Therefore, you should remove the what? The discount. Okay. So the keyword was list price. But if they are saying what was the total total sales return, you could have written 3,000 for 30 May. But for the whole for 31st May, yeah. But for the total now, the total of the things that were just removed, it could have been 8,000 because you could have added those returns for June and those for May. Aye. But yeah, that's what is involved in the question. Clear?
Clear, sir.